In Part 1 of Chapter 22, we made a sales budget for Miles Manufacturing. In this section, we will be preparing production budgets for the firm. In order to prepare a production budget, you need to know some more information about Miles Manufacturing. We're told that the firm expects that it will begin the current year with 14,000 units of finished goods already in inventory. In addition, we are told that Miles Manufacturing wants to end each month with 140% of next month's projected sales already in inventory. This is the firm's inventory policy. Different firms have different inventory policies depending on how long it takes each firm to make its product, how variable the demand for the product is, and how long it takes to get direct materials needed to manufacture the product. The more uncertainty there is, the larger amount of safety stock the firm would want to have at the end of each month. We need some formulas to help Miles Manufacturing figure out how many units to produce. The first formula is that the amount of expected sales in a given month plus the desired ending inventory balance at the end of the month equals the total units needed. If a firm expected to start the month with nothing in its finished goods ending balance, then the firm would have to manufacture all of these units during the month, some to sell and some to have left over at the end of the month. But if a firm expects to have units at the end of the previous period, those units will still be available the next day at the start of the current period. Therefore, out of the total units needed, we can subtract out the units that we expect to have already available to us, and the difference will tell us the number of units that we need to produce in that month. Let's take a look at the production budget for Miles Manufacturing. The production budget starts with the number of units that the firm expects to sell in each month. That information is available from the sales budget that we prepared in Part 1. In January, the firm expects to sell 10,000 units, but it wants to end the month with extra units going into February. How many units does it need? The firm's inventory policy says that it would like to end January with 140% of February's expected sales. Therefore, in addition to the 10,000 units that the firm expects to sell in January, it needs an additional 16,800 units to start February, in case there's a snowstorm or some other disruption in their ability to produce units, or if a lot of customers come in the beginning of February demanding their product. it would be bad for the firm to disappoint those customers by having a stock out, being out of the units that the customers want to buy. If we add the total number of units that we expect to sell in January, plus the units that we want to have left over at the end of January going into February, that gives us the total number of units that Miles Manufacturing needs to have. But they don't have to make all of these units because they expect that they will end the previous December with units already in the finished goods inventory. So they don't have to make those units in January. We were told that the firm expects to have 14,000 units already in finished goods at the end of December, which means they'll be there at the beginning of January. If we subtract those units from the total number of units that the firm needs, that will tell us the number of units that the firm must produce during January. In February, the firm expects to sell 12,000 units. But they want to have units left over at the end of February going into March. How many units do they need? They expect to sell 15,000 units in March. Multiply that by their 140% inventory, and that tells us that in addition to the 12,000 units that they expect to sell in February, they need an additional 21,000 units for the end of February going into March. Add the units that they believe they'll sell in February to the extra units that they want to have at the end of February, and that tells us how many units they need. But they don't have to make all of these units because one period's ending balance becomes the next period's beginning balance. This firm expects to end January with 16,800 units in its finished goods inventory. So we don't have to make those units in February because they'll already be available. So the difference between the total units that they need and the ones that they expect already to have on hand tells us how many units they need to produce in February. In March, the firm expects to sell 15,000 units. And they want to have some extra units at the end of March going into April. April is not part of this budget, but we were told how many units the firm expects to sell in April, and we need that information in order to figure out how many units the firm wants to have left over at the end of March. So we can compute 140% of April's expected sales, and that becomes the desired ending balance for March. Altogether, the units that the firm expects to sell in March, plus the units that they want to have left over at the end of March, equals the total number of units that the firm needs. But again, they don't have to make all of these units because one period's inventory ending balance rolls over the very next day and becomes the next day's inventory beginning balance. In this case, the firm doesn't have to make the 21,000 units that were left over at the end of February. Those units should already be available. The firm only has to make the difference between the units that it needs in March and the units that it already expects to have on hand. Based on this information, we've figured out how many units the firm has to produce in each month of the first quarter of next year. Note that if this firm used just-in-time inventory, then none of this would be necessary. In a just-in-time firm, the production plan would be for the firm to make as many units as it expects to sell. In order to make these units, the firm needs its three factors of production: materials, labor, and overhead. So we need budgets for each of these factors. In order to make a direct materials budget, we need to know what goes into this firm's product. Most firms make products that have lots of different kinds of materials. This particular firm only uses one kind of material. It needs 3 pounds of that material to make each unit, and it expects that the material will cost 60 cents per pound. The firm has an inventory policy for its direct material as well. It expects that it will end last year and begin this year with 20,000 pounds of material already on hand. But it wants to end January with 30,000 pounds, end February with 35,000 pounds, and end March with 40,000 pounds. Now we need some formulas to determine how much material they need to buy in each period in order to have enough material to make the units that they plan to make in each month and have the right amount of inventory left over at the end of the month in case something interrupts their supply chain. The amount of direct material per unit times the number of units tells us the total amount of direct material that we need for current production in each month. Then, if we add the desired amount of ending inventory for that month going into the next month, that tells us the total amount of material that we need. But the firm doesn't have to buy all of that material because it expects already to have some material on hand. So the amount of material that the firm needs minus the amount that it expects to have at the end of last period, which immediately becomes the beginning balance in the current period, tells us how much material they need to purchase. If we take the amount of material that they need to purchase and multiply it by the cost per unit for the material, that will tell us how much money we need in order to buy the material in that period. Remember that the direct materials budget is based on the number of units that the firm expects to produce, not the number of units that the firm expects to sell. So we go back to the production budget, not the sales budget, to get the number of units that the firm wants to produce in January, February, and March. In January, we take the number of units that the firm wants to produce and multiply it by the number of pounds of direct material that goes into each unit. And that tells us the total number of pounds that the firm needs for production in January. In addition, we were told that the firm wants to end January going into February with an additional 30,000 pounds of material. So the amount that the firm needs for production plus the firm's desired direct materials ending balance tells us how many pounds of material the firm needs. But the firm doesn't have to buy all of that material because it expects to end December and start January with 20,000 pounds of material already on hand. If we take the total amount of material that the firm needs and subtract out the amount that they expect already to have, the difference tells us the amount of material that the firm needs to buy in January. If we multiply that by the 60-cent cost per pound, that tells us that the firm needs a little more than $29,000 in January just to buy its direct materials. In February, we can take the number of units that the firm expects to produce and multiply it by the 3 pounds of material per unit. And that tells us how many pounds of material the firm needs for production. And we were told that the firm wants to end February going into March with 35,000 pounds of material. The amount that they need for production plus their desired materials ending balance tells us the total amount of material that the firm needs. But again, they don't have to buy it all because they expect to end January with 30,000 pounds on hand. So the total amount they need minus the 30,000 pounds that they expect already to have tells them the amount of materials that they need to buy. Multiply that by the 60-cent cost per pound tells us that the firm needs a little more than $32,000 to buy materials in February. Same thing happens in March. We take the number of units that the firm expects to produce, multiply it by the 3 pounds per unit to get the amount of material for production, add in the desired ending inventory of 40,000 pounds to get the total amount of materials needed. but the firm doesn't have to buy it all, because one period's ending inventory becomes the next period's beginning inventory. At the end of February, the firm expects to have 35,000 pounds going into March. So the total amount that the firm needs to buy is the total amount they need minus the 35,000 pounds they expect already to have. Multiply that by 60 cents per pound, and we find that in March, the firm needs almost $20,000 just to buy materials. Altogether, this direct materials budget tells the firm how many pounds of material it needs in January, February, and March, and how many dollars the firm needs to have in order to buy all of that material. A direct labor budget is always a little bit easier to prepare than a production budget or a direct materials budget, because labor can't be saved from one period to the next. It is used up in the same moment when it is created. We're told that Miles Manufacturing takes 6 minutes of direct labor to make one unit. Don't forget, that means that it's 1/10 of a direct labor hour per unit. Workers at Miles Manufacturing earn $10 per hour. To make the direct labor budget, remember that we need the number of units to produce from the production budget, not the number of units that the firm expects to sell. In January, we take the number of units that need to be produced, multiply by 1/10 of an hour per unit to get the total number of labor hours, and then multiply by the hourly wage to get the total number of dollars needed in January. In February, we do the same thing. We multiply the number of units that we expect to produce times 1/10 of an hour per unit to get the total number of labor hours, and then multiply by the hourly wage to get the total number of dollars needed to pay our workers in February. And in March, we take the total number of units to produce, multiply by 1/10 of an hour per unit to get the total number of labor hours, and then multiply by the hourly wage to get the total number of dollars that we need to pay workers. Based on this direct labor budget, the firm can easily see how many labor hours it needs in each month to produce the units. And the firm has a chance now, before the period ever starts, to make sure that it has enough trained workers for each month's production, and to think about how it might deploy its workers in months like March, when they don't need as many labor hours for production, but they may be able to find some other useful training or other firm needs for those workers. The budget also shows how many dollars the firm needs in each month to cover the cost of Remember that manufacturing overhead has both a variable and a fixed component. We start the manufacturing overhead budget with the number of units to be produced in each month, which comes from the production budget. In January, we take the number of units to be produced, multiply by the production time, which is 1/10 of an hour per unit that was given in the labor budget, and that tells us the total number of labor hours. If the firm based its variable manufacturing on machine hours, then we'd have to have data for the number of machine hours. We can take the number of labor hours in this case and multiply it by the firm's variable manufacturing overhead allocation rate, $3 per labor hour, to get the total dollars for variable manufacturing overhead. Add in the fixed manufacturing overhead per month to get the total cost of overhead for January. In February, we multiply the number of units times 1/10 of an hour per unit to get the total number of labor hours, multiply by $3 of variable overhead per labor hour to get the total cost of variable overhead, and add in $1,000 of fixed overhead per month to get the total overhead cost. And in March, we take the total number of units to be produced, multiply by 1/10 of a labor hour per unit to get the total labor hours, multiply by $3 per labor hour to get the total variable cost, add in the total fixed cost to get the total overhead cost budgeted for March. Altogether, the manufacturing overhead budget tells the firm how many dollars it's likely to need in January, February, and March to cover its manufacturing overhead costs. This is the end of Section 2. In Section 3 of this chapter, we will be talking about how to prepare the firm's selling and administrative budget.